Good afternoon, everybody. This is Andrew Wilkinson with Interactive Brokers. I'm the Director of Trading Education. Welcome to today's event, which is the Innovation ETFs and Historical Index Returns, brought to you in conjunction with Drawing Capital. And I'm very pleased to have a couple of wonderful guests from there who have been on the platform before. If we can just put up the disclosure slide just for a couple of seconds to let people know that some of the risks involved in investing. We can forward to the second slide. And in a moment, I'm going to hand over to my colleague down in West Palm Beach, Rob Moore. Before I do that, I just want to let you know that today's session is being recorded. So if you can't hang around, it will be available on the Interactive Brokers website later in the session. Later today, rather, it'll probably appear in your inbox in a couple of hours after the event ends. The PowerPoint of today's presentation is also available in the GoToWebinar chat panel. You can download the PDF there, and if you have any questions, please put them into the chat panel for our guests. So before I hand over to Rob, Sean, could you advance the slides one to the disclosure page, please?
Oh, sorry.
That's okay.
Mine shows that it's advancing. There we go. Sorry.
Brilliant, lovely. Okay, so I'm going to hand over to Rob Moore. Rob, welcome to today's event. It's been a while since we've had you on here. Who have you got presenting for us today?
Andrew, thanks so much. Welcome, everybody. My name is Rob Moore. I'm on the institutional sales team here at Interactive Brokers in our West Palm Beach office. I'm pleased to introduce Sagar Joshi and Sean Vanderwall to present today's webinar regarding innovation ETFs and historical index returns. They are co-managing partners at Drawing Capital, which is a technology-focused investment firm that seeks to invest in disruptive innovators across a range of fast-growing themes. And looking forward to today's webinar. And with that, I will turn it over to Sean and Sagar. Thank you.
Thanks, Rob. And hi, everyone. Thanks very much for joining us today. As Rob said, my name is Sean Vanderwall, managing partner at Drawing Capital. And I'm also joined by my partner, Sagar. We started Drawing Capital in order to provide clients with a way to invest alongside our highest conviction opportunities. It wasn't just closet indexing and helped as an important diversifier of growth for the rest of the portfolio. But today specifically, we'll be discussing innovation ETFs, the marketplace for these funds, and historical index returns. And a few important disclosures that we need to mention first. This presentation may not be reproduced in whole or in part without express consent of Drawing Capital Group, LLC, also known as Drawing Capital. This presentation is not an offer to sell securities of any investment fund or a solicitation of offers to buy any such securities. Past performance of these strategies is not necessarily indicative of future results. There's the possibility of loss, and all investment involves risk, including the loss of principal. Drawing Capital may own securities discussed in this presentation. The information in this presentation was prepared by Drawing Capital and is believed by Drawing Capital to be reliable and has been obtained from sources believed to be reliable. Drawing Capital makes no representation as to the accuracy or completeness of such information. Opinions, estimates, and projections in this presentation constitute the current judgment of Drawing Capital and are subject to change without notice. So from there, topics covered today. First, I'll start off by discussing some historical context of indices and index returns. And then my partner Sagar is going to take us through relative returns, the benefits and criticisms of ETFs, the 4 evolutionary waves of index funds, and finally, some opportunities in ETFs going forward and innovation ETFs themselves. For some historical context here, first developed in the 1990s, ETFs were formed to satisfy 4 different investor desires and needs. First, with the prevalence of financial planning, many retail investors have some long-term target return in mind that they'd like to achieve. Mainly, this is the rate of return required to satisfy any anticipated future expenses and liabilities adjusted for corresponding rates of inflation. Second, by acting passively and with a permanent state of diversification, investors hope to avoid the permanent loss of capital and ideally not burden themselves by sustaining any substantial long-term losses. Third, by mimicking an index, especially those that are market cap weighted, the portfolio requires minimal turnover and thus results in a lower tax bill each year. This is contrary to many mutual funds, which often and unexpectedly deliver investors a big tax bill through year-end distributions. And fourth and finally, reasonable management fees. Again, by mimicking some index passively, much of the rebalancing and human capital can be reduced through technology, resulting in very low management fees, often in the range of 3 to 5 basis points for passive US-based index funds. Now, some of the most common investor questions associated with picking an ETF, although not exhaustive, are what is the target return of an investment? Will it help me meet my financial plan's target return while minimizing some downside risk? What is the probability of achieving this target return? And finally, what are the costs, taxes, and restrictions associated with its investment? With that framing of these parameters and questions in mind, we'll dive a little bit deeper into the ETF industry as a whole. So the three main ETF issuers dominate the industry, managing nearly 79% of the assets in this category. BlackRock's iShares at over 36% of the total AUM, Vanguard funds almost 28%, and State Street SPDR funds at about 15%. As for leading index creators, the top three entities also comprise about 70% of the total market share. This is measured by 2019 percentage of industry revenue. So these include MSCI and S&P Global, which are both just shy of a 25% market share, and FTSE Russell at over 20%. And as we can see from both this slide and the previous one, that ETF issuer and index creator markets, there's a concentration in winner-take-most type of environment. Now, when tracking the stock price performance of both the fund companies, such as BlackRock, Charles Schwab, and State Street, versus those of the index creators, such as S&P Global and MSCI, the creators have vastly outperformed the fund companies over the last 10 years. This is largely due to the rise in passive investing in the index creators sharing in the business and revenue generated by the fund companies, but not having to create the investable funds themselves. The fund companies have also dealt with massive pressure on fees in recent years, with companies like Schwab bringing operating expense ratios down to as little as 2 basis points per year. Now, from 2011 to 2020, returns by comparison for the index creators, S&P Global has returned 990%, MSCI 1,119%, followed by three of the leading fund makers, BlackRock at a 395% stock return, Schwab at 243%, and State Street at 90%. But then we should ask ourselves, really, what are the roles of these index creators? So previously, index creators were simply a financial data source that was necessary to establish and maintain the accuracy of a benchmark represented by some group of the largest companies. Today, the creators have taken on a series of additional roles. They provide the same same information and data. This data feed can usually be purchased directly. For example, S&P Global, I think, charges about $2,000 a month for such data feed. They create the indices themselves and establish the parameters for the inclusion and exclusion of certain companies. They generate revenue through licensing. The fund companies have to pay S&P a fee to call their index fund an S&P 500 index fund. In this way, the index creator can capture additional revenue with basically 100% contribution margin from this. Lastly, they've found they have a profound impact on asset prices through the addition or subtraction of a company's stock in the index. Given the growth in asset flows to passive index funds, those added to the index instantly gain a bump in their market cap. For example, those of you that follow the S&P 500 stocks closely, Etsy's inclusion led to a daily gain of about 6.8%, and the announcement that Tesla would be included in the S&P after being passed over the first time led to shares popping about 13% that day. Some common parameters that might be observed for selecting an index fund are tracking error. A lower measure of tracking error means that the fund manager is doing their job and adapting quickly to changes in the index and can be deemed more efficient in its purpose than those with a higher tracking error, low cost for the same product or end result that all investors are hoping for, that is the index returns. The next objective becomes minimization of costs for such services. The provider reputation, there's a familiarity bias that takes place as well, even though Schwab's S&P 500 fund has a lower expense ratio than Vanguard. Many investors still elect to use the Vanguard managed fund due to their known dominance and familiarity within the marketplace. AUM, so psychologically or assets under management, people tend to follow the herd, and thus, why wouldn't a fund with more AUM be the right place to be? Index characteristics, does this fund grant me exposure to a sector or asset class that I think will better meet my objectives than a competitor fund? And finally, ancillary benefits. These are usually less well researched by retail investors in general, but characteristics like marginability, how much can you borrow against this fund, securities lending income, are people shorting the security, and can I earn some supplemental income by lending it as a result? And then the use of leverage or borrowing by the manager all play a factor in evaluating an ETF for investment. And then finally, for this section, just wanted to touch on a few other indices which specifically measure volatility. These can be used either in a speculative fashion in order to try to achieve some degree of short-term appreciation, or as a defensive hedging mechanism to offset negative portfolio volatility. So the MOVE index measures the volatility of the US Treasury bond market. The VIX measures volatility of the S&P 500 index. And finally, VOLQ measures the volatility of the NASDAQ 100 index. And before diving into some of the opportunities that lie ahead in this market, let's quickly just revisit where we've been historically here. So last year was a historical year for both the pandemic and the NASDAQ 100 index, which benefited immensely from exposure to technology and biotech companies, which were essential in helping companies navigate the COVID crisis. So the NASDAQ returned 47.68% from 2020, followed by the Russell 2000 at 18.36% return, the S&P at a 16% return, and the Dow Jones at 7.43%. In the next few slides here, let's look at each index more closely. We move the timeline back to 1988. In the next few charts, I'll scroll through. Notably, you can observe the magnitude of expansions and contractions, especially around the tech bubble growing in 1998 and 1999, and finally crashing from 2000 to 2002, and the global financial crisis in 2008 and its subsequent recovery. The NASDAQ is here. S&P 500, Dow Jones, and finally the Russell 2000. Collectively, the best and worst calendar year performance can be observed as follows, with the NASDAQ realizing the greatest upside of almost 102%, and also the greatest downside of almost 42% in a given year, ranging to the Dow Jones, whose most positive year was up 33.4%, and a worst year actually being a larger absolute move of downwards 33.8%. Interestingly, even though the NASDAQ is thought of as the index with the greatest amount of risk generally, the number of years with negative performance from 1988 to 2020 was actually the least at 6 years. This is followed by the Dow Jones with 8 total negative performing years, the S&P at 9 years, and the Russell 2000 at 10. And especially in volatile markets, as we're experiencing now, it's important to remember that the holding period has a substantial impact on long-term returns. And again, in the context of this financial planning process, it's important to keep this in mind for everyone. So if you randomly bought into the NASDAQ 100 index and the S&P and held that position for 12 months at any point in time from 1988 through 2019, the following data could be observed. You would have had a positive return for either index more than 80% of the time. The S&P 500 would have given you a 10% return or more for 1 year more than half of the time, and the NASDAQ would have given you a 33% return or more on 1 out of 5 years. Now say we utilize the same indices, but increase the holding period now to 10 years. So investors would have had a positive return, again, for both indices, almost 90% of the time. The S&P 500 index would have allowed you to double your money about half of the time. The NASDAQ would have allowed you to double your money nearly 80% of the time. And now consider this as one of our primary investor demands, is that the positive return on capital, although not a guarantee historically, the odds have been significantly tilted in your favor over a longer period of time, kind of 10 years plus in mind here. And now I want to pass the baton to my partner Sagar, who's going to start off by discussing relative index returns.
Thank you very much, Sean, for sharing lots of excellent ideas and insights, and I appreciate the kind introduction. In this section, we will review the relative returns of various indices. As we move to the next slide, we can see that large companies, as measured by the S&P 500, have outperformed small companies in aggregate for the past several years. This chart graphs a ratio of percentage returns of Vanguard's VFINX mutual fund relative to the percentage returns of Vanguard's small cap index fund. This type of performance ratio analysis for various asset classes and indices is displayed in the following charts in this section and is useful in visualizing relative returns. As we move to this slide titled Growth and Value, we can see that growth-oriented companies in both large cap and small cap indices in America have outperformed traditionally defined value-oriented companies in the past 3 years, with a notable upward spike starting in 2019. The combination of a low interest rate environment and a significant expansion in money supply over the past year has created the acronym called the TINA effect, which stands for There Is No Alternative. Low prospective yields in cash savings, money markets, and traditional investment-grade bonds compared to historical norms have caused more investors to increase their investment allocations in growth-oriented stocks, real estate, and alternative investments in hopes of seeking positive inflation-adjusted returns that map with their personal financial plan. Moving to the next slide here, we can see that the market cap weighted S&P 500 has actually outperformed the equal weighted version of the S&P 500 as seen by SPY versus RSP as these ticker symbols are displayed. This implies that the largest companies are getting even bigger in market cap. As market cap S&P 500 index funds continue to absorb more investor capital, a disproportionate share of each incremental dollar automatically gets invested into the largest companies, thereby creating a positive feedback loop for large companies to have a recurring flow of buyers for their stocks. We can now see that when we analyze QQQ versus the SPY ETF, which is a proxy for the S&P 500, we can see that QQQ has notably outperformed SPY over the past decade. Notably, NASDAQ has more technology and biotech exposure than the S&P 500. The key lesson here is that being pessimistic on technological innovation in the long term is a losing proposition. Technology is not just a sector nor a short-term trade, and technology is a multi-generational tailwind that is increasingly an integral part of business operations for many companies. Technology can improve consumer experiences, increase revenue, decrease costs, enhance efficiency, and enable global distribution. We can now see, moving to this slide and the next one, we can see for both emerging markets as well as European equities, US equities have actually enjoyed a nice decade of growth, both numerically and relative to both European and emerging market stock indices. And then on this slide titled US equities and US REITs, we notice that while both US equity and REIT indices have done well in the past decade, a sharp rise in outperformance of US equities over US REITs began in 2016. In this section of the presentation, we will now evaluate the popular benefits and criticisms associated with index funds. This slide here highlights the 9 traits that are commonly cited as key benefits of index funds. In terms of low cost, there's a proliferation of no-load, commission-free index funds that charge less than 10 cents per year per $100 investment into an index fund. Transparency is also another key benefit in that investors generally have an idea of the types of securities being purchased and rebalanced inside index funds. Liquidity is also a nice trait, and with a mobile app, retail investors can easily convert their index fund investments into cash. Index funds also provide diversification and access by providing the ability to invest in various asset classes, industries, and themes in a low-cost manner with low investment minimums. As we move to the next slide, we can contrast the previous slide with this slide, which highlights the popular criticisms associated with index funds. First off, many index funds are backward-looking in that many index providers choose the composition of an index's holdings based on current or past data instead of making a forward-looking projection about a company and its valuation. Second, index funds can influence the prices of stocks and bonds, as Sean mentioned earlier. When a stock or bond is included or excluded from an index, this decision by the index committee has positively or negatively impacted market prices via human interference. Furthermore, index investing is inherently a momentum strategy because more capital going into market cap weighted index funds leads to more investment in the largest companies. The ninth criticism listed on this slide points to the potential downside of excessive diversification. A question emerges in that when an investor pools together dozens and dozens of index funds in a portfolio, does the investor really need all of that exposure to tens of thousands of securities? Or is this excessive diversification actually reducing returns? Fascinatingly, academic research from Professor Bessenbinder and his co-authors found that the best 811 companies, or about 1.33% of global companies, accounted for all net global wealth creation in stocks from January 1990 to December 2018. All in all, while index funds both have benefits and downsides, it's the role of a good investor to accumulate the benefits and minimize the downsides. Index funds can certainly have an important role in a portfolio. The decision to self-manage your investments or delegate to a financial professional is often based on your time, knowledge, experience, one's degree of financial complexity, and interest in financial markets. As we move to the next slide, it's important for investors to be aware of some of the key nuances in both equity and bond indices. U.S. stock market indices, such as the S&P 500 or the Dow Jones, are not static. Underlying companies and sector weightings inside these indices change over time. The same applies to bond indices as well. Notably, about half of the NASDAQ QQQ's ETF allocation is composed of shares in so-called FANGMAN companies, which is an acronym that describes Facebook, Apple, NVIDIA, Google or Alphabet, Microsoft, Amazon, and Netflix. In the Bloomberg Barclays U.S. Corporate Bond Index, average duration has steadily increased from about a duration of 5 in 1992 to about a duration of 8 in 2020, implying that this index has added duration or interest rate risk in the index over time. Furthermore, BBB rated bonds have risen in issuance and make up about half of the investment grade corporate bond market. As a result, investment grade corporate bond indices have heightened embedded interest rate risk and credit default risk here today. In the final section of this presentation deck, we'll now review the term disruptive innovation and discuss opportunities in innovation ETFs. Pioneered by author Clayton Christensen in the book titled The Innovator's Dilemma, the term disruptive technology refers to a new company creating something that is faster, cheaper, and more convenient to the consumer compared to the incumbent suite of products or services to such a degree that it disrupts the economics of the incumbent. Disruption does not simply indicate something that is new and different, and innovation implies a change in human behavior that substantiates progress. As we see in this slide here, titled 4 Waves in Index Funds, we notice 4 evolutionary waves in index funds. The first wave of index funds were created to track and mimic the performance of popular benchmark indices, such as the S&P 500 or the NASDAQ. Over time, with the growing adoption of modern portfolio theory and knowledge of the efficient frontier, a rising demand for asset allocation, automatically rebalancing index portfolios, and risk-adjusted returns emerged, which thereby drove the growth of robo-advisors, target date funds, and asset allocation funds. The third wave of index funds is embodied by the proliferation of specialized index funds that track industry-specific, custom, and thematic themes and indices. These specialized index funds allow investors to increase their specificity in investment exposure to a specific asset class or theme. The key potential value add of these specialized index funds is the opportunity to generate potential performance alpha by investing in specific high growth and trending themes. The fourth wave for indices is the rise of direct indexing, which introduces the potential tax advantages associated with tax loss harvesting at the individual security level and further customization of index portfolios. As we move to the next slide, we notice that there are 4 common traits in hopes of performing better than traditional index funds. First, high active share implies that an investor's portfolio is invested differently compared to a benchmark index. Exceptional investors are both contrarian and correct. Contrarian can be measured by having high active share in a portfolio, and being correct in the portfolio sense can be measured by high performance returns. Second, maintaining a low portfolio turnover implies 2 advantages. First, the ability to be a long-term investor provides a duration advantage that allows potential positive compounding of returns over time. The second advantage is that a low portfolio turnover can be tax efficient. A third trait is maintaining a sustainable competitive advantage, which often occurs by specializing in a specific industry or investment category, refining one's craft and expertise in the investment category, and remaining within one's circle of competence. A fourth trait is having committed capital with little behavioral bias. Negative behavioral biases unfortunately lead to decaying returns or suboptimal outcomes over time due to emotional investing decisions. Maintaining a long-term financial plan with committed capital and a series of guiding frameworks often leads to better financial outcomes. As we move to this slide, we categorized a series of ETFs based on specific innovation categories. Notably, the 2020 performance and rising popularity of many of these innovation-focused ETFs, as measured by both 2020 performance returns and increases in assets under management for these innovation-focused ETFs, highlight the growing demand for investing in innovation and high-growth companies. The selected innovation themes on this slide include biotech, climate change, cybersecurity, and e-commerce. All of these ETFs listed on this slide outperformed the S&P 500 in 2020, and a few of these ETFs more than doubled in value in 2020. The next slide of sample innovation ETFs highlights esports, gaming, fintech, and growth investing. Notably, ARK's flagship innovation fund under ticker ARKK experienced an over 9x increase in AUM between the beginning and end of 2020. The following slide of sample innovation ETFs selected by Drawing Capital focuses on the Internet of Things, connectivity, robotics, automation, semiconductors, and hardware engineering, software, and cloud computing. A key ETF to highlight on this slide is under ticker WCLD, which more than doubled in value and performance returns to investors in 2020 and also increased its AUM by a staggering 89x between the beginning and end of 2020, demonstrating the significant optimism among investors in accessing broad index exposure to publicly traded cloud and software companies. And on that note, thank you everyone for attending the webinar, and thank you to Interactive Brokers for hosting the webinar presentation. We really appreciate your interest and enthusiasm in the topics discussed today. We enjoyed presenting to all of you and would love to answer any questions you may have about historical index data, innovation-focused ETFs, and anything else we've presented here today. As a friendly reminder, a PDF version of this presentation deck will be available on the Interactive Brokers webinar website, or please feel free to email us directly at invest@drawingcapital.com to receive the presentation deck. Also, it seems that several positive questions are coming through the live question forum chat. We will now read aloud questions and provide our commentary. Looking at the question and live forum chat here, one question is, where can I learn more educational ideas and insights from Drawing Capital? Wonderful question. Drawing Capital publishes a free weekly newsletter regarding the innovation economy and market commentary, which can be found at drawingcapital.substack.com. In addition, you can visit us at drawingcapital.com, or please email us directly at invest@drawingcapital.com. The second question here is the following, which is, the ARK investment team has captured the attention of many investors, particularly through strong historical performance and a passion for exploring innovative technologies. What are your thoughts on their innovation-focused ETF approach? Well, our answer would be that both ARK Invest and Drawing Capital share a high degree of enthusiasm for investing in transformative and disruptive innovation. Investing in good, innovative companies accelerates and amplifies their positive impact. While there are a few key differences between ARK Invest and Drawing Capital, we share the same underlying theme of disruptive innovation. At Drawing Capital, we believe that a significant source of future performance returns in the coming decade will derive from investing in best-in-class, innovative companies and technology platforms that are led by phenomenal management teams. Another question was focused on the following, which is, are there performance data available in Interactive Brokers based on the common traits you described here for index funds? There is. So Interactive Brokers has a range of key analytics inside and a lot of screening tools as well. So you have the ability to screen for various index fund data, look at performance returns. You can also type in the index or index fund, and there's a lot of graph capabilities on the Interactive Brokers platform, both on the web trader as well as their advanced trading platforms. So great question there. Another question is, are there innovation indices that use long short for favorable sectors or industries in each sector, depending on the current business cycle? That's a great question. There are a few indices that are either coming out soon or have already been created for retail investors to use as either a proxy for a benchmark for performance basis, or even more index funds that are created from it. So for example, a recently created index was called the Kensho Moonshot Index that focused on specific innovative sectors. Now, of course, some are going to be more focused on a specific category and some are more broad. So for example, the Moonshot category has a more broad range, and then there's other sector-specific funds or industries within a sector that will be even more tailor-made to a specific topic. So for example, within healthcare, there are index funds like XBI or under ticker IBB that track biotech within the healthcare ecosystem. Another great question here is the following, which is there a positive correlation between the amount of quality companies in an index and its returns? Great question there. So certainly in many major indices, the overwhelming majority or a significant percentage of contribution from an index comes from its top performing names. And so sometimes we'll need to go index by index, but sometimes there is a high degree of correlation between the constituents within an index, and other times there's a high degree of dispersion whereby there is a big delta between the underlying holdings of the index, with the ideal goal of having that index either drift higher over time, especially if you are a long-only focused investor. Another great question, and speaking to the growth-oriented nature of investing, the following question is, based upon the ongoing volatility due to high yields, possible interest rates, increases in inflation, etc., where should we focus in terms of index funds? You know, this is a great question. There's certainly been a lot of discussion about inflation and inflation expectations. There are certainly a number of ways that investors are rebalancing their portfolios accordingly. Some investors are increasingly shifting more and more assets into physical, scarce and hard assets. So real estate, commodities, physical land, etc. Some are shifting more and more into digital assets. We see this with Bitcoin. We see this with the rise of NFTs, etc. In the fixed income market, there are certain types of hedging approaches that can be done. Floating rate loans allow investors to actually participate on rising yields because they are floating rate in nature. Some investors have shortened the duration of their bond indices, so specifically targeting shorter term bonds to reduce their interest rate sensitivity compared to, let's say, buying a 30-year type bond. Now, of course, that type of duration shortening does come with a trade-off in yield. And in terms of growth assets versus interest rates, this is a really interesting question. What we already saw in late February and early March was that as interest rates rise, we saw a slight drop off or sell off in some of these high flying stocks that we saw in 2020. We feel that this is a very normal occurrence in that as interest rates rise, or really as discount rates rise, the present value of cash flows can decrease, and thereby changing the investor perception of what they're willing to pay. There's also been really a normalization of what is considered, quote, investable. So in 2020 versus 2021, as 2021 continues throughout the year, and as the general economy opens up a little bit more, and as there's more and more COVID vaccine distribution to millions of people, there is the hope that people are going to be traveling more, people are going to be engaging in more, quote, normalized activity and behavior. And so compared to 2020, where a significant portion of investment gains occurred in the technology and biotech sector, we're actually seeing a broadening out of investor gains across many different sectors and industries, not just tech and not just a few select names that we saw in 2020. Another great question was about drawing capital, which was how old is drawing capital as an investment firm? That's a great question. So drawing capital was started last year in 2020. And we're really excited about the future here ahead.
All right. Well, thanks again, everyone, for attending. We certainly enjoyed this. If you have any additional questions or want to follow up to discuss anything that's occurring in the innovation economy and the opportunities ahead, happy to take that offline. Again, best email is invest@drawingcapital.com, and hope you have a great day.
Thanks to our presenters for joining us today, both Sagar and Sean van der Wal. We definitely appreciate you coming along. Don't forget, folks, there will be an email in your inbox in about 2 hours from now as the session winds up, and we'll send you a link to today's recording, and you can always reach the two presenters at Drawing Capital using their email, invest@drawingcapital.com. Thanks, everybody. Bye for now.